Hey everybody, Chuck Barone. Wednesday, June the 28th, 2023, and a very, very interesting day today. We got Powell talking, we got the Fed releasing all kinds of stuff. Big day, lots of stuff to talk about. Before we get rolling though, let me welcome everybody to the show. Thank you guys for your support. You guys watching these videos every day keeps us going. We appreciate you guys. All right, so let's look at these markets today. Markets ending mixed, not a very good day at all. Not a bad day, just a not anything happening day really as far as anything remarkable in these markets. But we had Powell in Portugal. They had a meeting of all the brainiacs at all the different central banks. So you had Lagarde there and the English central bank, and you had the Japanese central bank, and so all these big shots meeting there, talking about basically the super hawkish, bearish talk about what they need to do, what they're going to do. Very, very strong presentation by all of them. Now we'll see if they actually follow through with deeds. Words are different, right? But the consensus being rates are not where they need to be yet, and they're going to need to stay high for much longer than the markets are anticipating or anybody else. We also had the Bank of America president today, Moynihan, coming out talking about the Fed, we're not going to get down to target inflation until maybe 2025. So he's talking about high rates not only for the rest of this year, but he's talking about forget rate cuts even for next year. They're going to need to keep rates elevated to get to that target. What do you guys think? Can the Fed lower rates before they get to their target? It's going to be fascinating to watch how all this stuff plays out. So let's look at these markets today. The stock markets end up mixed. The Dow dropping 74 points, 33,852. So basically neutral over the last 3 days. S&P down 1 point. So not a lot happening in the S&P. The index sitting at 4376. The NASDAQ actually up today. Good news for Apple, approaching $3 trillion in market value. NASDAQ up 36, 13,591 on the NASDAQ. Bond market today, well, prices actually going up, yields falling, go figure. So the 10-year dropped 6 basis points today, 3.71% for a 10-year U.S. Treasury. The 2-year drops 4 basis points, 4.72% for a 2-year U.S. Treasury. The inverted yield curve continues. It's, the story is on this inverted yield curve, because we had a little confusion, people talking about it in the comments. Okay, so here's the deal. No recession since, I think, 1950. No recession has happened without an inverted yield curve since 1950 or so. However, an inverted yield curve is not a 100% indicator of a recession coming. So that is not 100%. What is 100% is every recession since 1950 has been foretold by an inverted yield curve. So it's still a better indicator than not, right? So this inverted yield curve telling us, and has been telling us now for well over about a year or so, that this recession is coming, and we'll see when it actually happens, or if this is just going to be one of those weird times, the one in however many, where it doesn't actually predict it correctly. So the dollar today, moving on, the dollar up small today, 102.96 on the index, looking back to get up over 103. Not really much of an event either in the dollar. Gold and silver today down, with the stronger dollar, of course, that puts pressure on metals. So you got gold falling $4.60 today, $1,909.10 for an ounce of gold. Silver down 14 cents. $22.70 for an ounce of silver. Oil today, a little bit of a rally, up $1.45 per barrel, $69.15 for a barrel of West Texas Intermediate. We've kind of been telling you guys it wants to be between 70 and 75. this rally is not a surprise to us. We know it's going to get back into that trough. That's where it seems to be the most comfortable. Bitcoin today giving back a little bit of its gains over the past week or so, down $691, $30,013 for Bitcoin, still holding the 30,000 number. It's going to be, we'll see how this finishes the week here. If Bitcoin can stay above 30,000, head into the holiday next week, I think that's a really pretty bullish sign for Bitcoin. It's been above and up, it seems like it's been in that trading range, a lot like oil has been. So we'll see if it can break out to the upside. All right, so news you guys need today. As I was saying, we had Powell today in Portugal. Basically the message from Powell, to put it all in a nutshell, there was a lot of words but not a lot of news. But the basic nutshell is that Powell sees the Fed raising rates 2 more times this year. Now it's pretty much consensus that the Fed will raise rates again in July. Wall Street's still betting against this, betting on only that July increase and nothing else this year. But Powell himself said likely, and most of the Fed board agrees, 2 more increases this year. Now I think that you're having the weirdest market where it's data point to data point reacting. So I think that the way Powell feels about this today is certainly subject to change depending on the data that's in front of him. So that was interesting, and all the other central bankers talking very hawkishly as well. This inflation thing they know could be the ruination of governments, so they're going to do what they got to do to get this inflation number down. It's really interesting, though, because this next little piece I'm going to talk about here is going to talk about the effects of these Fed rate increases. When you go from 0 to 5%, I don't know if that's unprecedented, but it's certainly unprecedented in my lifetime to see the rates change that quickly in just 1 year. To go from really accommodating to really, I shouldn't say really restrictive, but when you're coming off of 0 and you have a debt-dependent society like we have now, don't forget, guys, the last time we had a big inflation like this, credit people did not have a wallet full of credit cards. All these different kinds of consumer debt that are available today weren't there then, okay? Corporations were not saddled with bazillions of dollars in debt. This just was not the world we were living in back then. So the Fed's activities, the lessons they gleaned from those activities that they're implementing now to bring, this inflation down, well, you got to look for this law of unintended consequences, right? When you raise rates that quickly, that high, especially starting from basically 0, it's going to have its effects rippling through the economy. Those effects typically are lagging, so they're not going to be right out in front. We've already seen the effect it's had on real estate, and the unintended consequence of people not now wanting to sell their houses because they're trapped in those houses by super low interest rates. People don't want to give, if you have a house, let's just talk easy. The house is worth $400K. You owe $300 on it. You got $100,000 in equity, and you got a 3% mortgage. Okay? People don't want to sell that house and take their $100,000 equity and move into another house, whether bigger or smaller, because today's prevailing rates between 6.5% and 7% mean that even if they took their 100, bought a house worth 300, put 100 into it, and had a $200,000 mortgage, their payment would still be higher than their existing payment today for the bigger place with the bigger mortgage. So that is just completely turning homeowners off from selling their houses, which is helping builders out like crazy, but certainly not helping real estate buyers out. Well, again, one of the simple unintended consequences of the Fed rate hikes, right? So now today, the point I want to get to. The federal economists, they're always researching the economy. They published a very troubling report today, okay? Listen to this. Fed researchers said, and get this, guys, this is a quote, "A historic surge in the percentage of distressed American companies could worsen the economic fallout from the Fed's inflation battle. Okay? So basically, what they're doing is they're warning that very high borrowing costs could cause a lot of companies in America to implode, either from the weight of their own debt, trying to refinance debt, trying to pay debt off, trying to get new debt. Very difficult, not only for people, but for businesses, okay? So they're saying that this access to capital, the cost of capital, could be a big problem for businesses. They said, listen to this. It's another quote. The share of non-financial firms in financial distress has reached a level now that is higher than during most previous tightening cycles since the 1970s. Okay? So, basically, now they're saying that the number of companies in this study in financial distress is higher than it's been since the last great inflation in the 70s. They said, economists, another quote, debt-ridden U.S. corporations will avoid spending on new development or facilities, hiring, or production. So what they're saying is these debt-strapped companies are going to be forced to curtail investing in their own businesses to service debt. Okay? This is going to put a big damper on the economy, obviously. The Fed's going to get their wish for slower hiring. Interesting stuff. They said that as of right now, okay, 37% of firms in the United States are in trouble. Okay? 37%. So let me translate that. What they're saying is it means more than 1/3 of U.S. corporations could default in the coming months due to this Fed tightening policy. 1/3. And I really think they're lowballing that because we know the trend has been corporate debt equals corporate profit, right? So now, guys, we have to really watch this. The next 18 months of this cycle are going to tell the story. Do not be surprised to start seeing familiar names in financial distress with bigger layoffs, declaring bankruptcy, walking away from properties, and doing the things distressed companies do. Very, very, very distressing report from the Fed today. Now we got tomorrow, we know we're going to get some interesting data tomorrow. We're going to get the final GDP report for the first quarter. We got unemployment numbers. On Friday we'll get the Fed's PCE. That's going to be very important, along with consumer data on spending and incomes. So the next couple of days are going to be very big data days for us, guys. Could move markets. I think the market's digesting everything that went down today. I think the United States economy clearly, the Federal Reserve basically announcing it with this paper. U.S. economy now starting to slide toward trouble. U.S. corporations in financial distress, 1/3 of them, 1/3 in financial distress. You can't make this stuff up, guys. It just keeps going and going and going and going. I thought this was going to be a very quiet week until tomorrow. Lo and behold, was I ever wrong? This paper today, if you go online, read some of the data from this paper, man, it is not inspiring. I think that, who knows, maybe this could turn into something good, though. Because as you guys know who've been watching this show for a while, I am very debt phobic, not a fan of debt of any kind. I think that maybe this could change the behavior of not only some of the consumers in this country, but of our corporations, our businesses, and their attitudes toward debt. This certainly would not be a bad thing for the economy going forward. If people were going to start living within their means, of course, that's not such great news for our corporate buddies. People are going to buy a little bit less of stuff, maybe not shop and spend money as frivolously. But it certainly would be good for the long haul, because what you don't waste money on tomorrow, you can invest in the next day. Or the day after that, you can buy something that's more meaningful to the economy rather than just a simple splurge. Anyway, guys, that's it for the day. Tomorrow, important data day. We'll be here to bring you guys the news you need. As always, we appreciate your support. You guys mean the world to us. It keeps us coming back here every day doing these videos. We'll give you guys the news you need tomorrow. Looking forward to a very interesting day. Until then, guys, take care. Thanks.